Alec Robinson.
Roxanne McKee.
Phil McDuffie.
Sarah Hudson.
Gavin Massengill. 5, 6 present. We will move on to public comments on items not on tonight's agenda. Miss Dare, do we have anything?
Is anyone signed up? No.
Okay. No one has signed up for public comments for items not on the agenda. With that, we will move on to the budget and tax rate agenda item. Agenda item number 2, discussion and possible action to set a public hearing on the FY 2022-2023 budget for September 21, 2022. I'll ask Ms. Wayman to walk us through this one.
This and the next item are just to set our tax and budget public hearings for the September meeting. That's when we'll do both of those and then adopt our budget that day. And then we will have a future meeting to adopt our tax rate.
Pretty straightforward, and I'd be happy to entertain a motion if someone has one.
I move to set the public hearing on the 2022-2023 budget for September 21 to 2022. I'm do it at 6 p.m. from 6 to 7 p.m.
Do we want to go early for the budget?
Yeah.
6 p.m.
Okay.
Yes.
Sounds good. You have
That's
a
the
motion. Is there a second?
Second.
You have a motion by Ms. McKee, a second by Ms. Brown. Is there further discussion, members? Hearing none, all those in favor say aye.
Aye.
Opposed say no. Being 5 ayes, no nays, motion carries. With that, we'll move on to agenda item number 3, discussion and possible action to set a public hearing on the proposed ad valorem tax rate for September 21, 2022. Again, Ms. Wayman, do you want to explain this one?
This is just same as the last, setting our public hearing for the September meeting so we can give adequate notice of that hearing for the public to attend.
Again, pretty straightforward, just setting the hearing date. Is there a motion?
I move to set a public hearing on proposed ad valorem tax rate for September 21, 2022, also at 6
Yes.
p.m.
All right, you've heard the motion. Is there a second?
Second.
A motion by Ms. McKee, a second by Mr. Robinson. Is there further discussion? Hearing none, all those in favor say aye.
Aye.
Opposed say no. Being 5 ayes, no nays, motion carries. And with that, we'll move on to agenda item number 4, discussion and possible action to set an ad valorem tax rate. And Ms. Wayman, if you'll get started, I will take it from there.
Of course. There are 3 attachments to the packet for this item. If you'll take a look at the 3rd attachment, this is the notice that we're required to deliver, giving you our no new revenue tax rates and our voter approval rates that have been calculated based on our values this year. The second one kind of gives the M&O and INS breakdowns of those 2 rates, the no new revenue and the voter approval rate, and talks about how much revenue we would get from that year's rate if we were to select one or the other. And then finally, just the purpose of this item is to set a proposed rate. At this meeting, whatever you set, you cannot exceed when you adopt your rate. So we generally recommend going for the highest you could adopt, so that way you preserve your optionality for the final meeting when you do adopt your tax rate. We've included the voter approval rates and the no new revenue rates here. The no new revenue rate would produce the same amount of revenues received in the previous year on the same properties that were taxed in both years. The voter approval rate would produce approximately 3.5% more revenue than last year's rate.
Excellent layout, Ms. Wayman, thank you. You didn't leave much for me to have to explain. I guess I'll just say a few words related to this setting of the tax rate. So historically, for the last at least 6 or 7 years, as long as I can remember, we've always published the higher option rate for us. Today's rate would be 3.5% if you go that route. Prior to 2019, we would post typically for an 8% option, which was the maximum before a rollback election was triggered. this relates somewhat to the conversation we had a few months ago, if you will recall, where I said if your plan, if you felt like we were going, your desire as a council was to do anything above the 3.5, or anything above the de minimis, we would need to know at that time, because it would have triggered a different set of notices and a different timeline. At that time, there seemed to be no sentiment by council to do anything above the 3.5. So that train has already left the station. The train that is left in the station now for you, there are 2 trains left in the station. One is to post the no new revenue rate, which would guarantee that you would adopt the no new revenue rate, or maintain a little bit of optionality and just publish the 3.5%, which at this point is the highest that you can go. Again, that's the staff recommendation. That's my recommendation. It is how we've historically done it. It is also how we did it last year, in fact, and still came back and adopted the no new revenue rate. For those listening at home, the previous council, or the council, last year adopted the no new revenue rate even after posting the 3.5%. So that's still an option, and we will have that discussion at the next meeting. So, any questions on any of this?
I have a motion. A motion to set the proposed ad valorem tax rate at the voter approval rate.
You have a motion. Is there a second?
Second.
You have a motion by Ms. McKee. I didn't hear who was it. Phil and Phil with the second. Is there further discussion? Hearing none, all those in favor say aye.
Aye.
Opposed say no. Being 5 ayes, no nays, motion carries. We are just moving right along.
So can I, one clarification
Yes.
on that? It says the voter approval rate. It's really the rate that the voters don't have to approve.
It is confusing. I have made that point over and over and over. I don't know why it is. It is the legislature.
I know,
that
but
gave it
just for
that.
anybody out there watching, so that they would know that.
It is
that
the
they-
rate that is infinitesimally below the actual voter approval rate.
Right. It is a rate that we can approve without any vote,
Yes, that is correct.
other than us.
That is correct.
And it's just,
Do have to vote.
well, I know, but
Yeah.
it's a very confusing
It is.
terminology
It is.
on there, so.
It is.
Mhm.
I agree with that.
Okay.
And we'll actually have more discussion at the next meeting about that rate and the history of that rate and some of those issues. So, all right, moving on to bond election presentation and workshop. I think I'm going to call up actually probably both items 5 and 6 together, so that we can have kind of a robust discussion and take it wherever council would like to. Bring up agenda item number 5, presentation from the city's financial advisor, U.S. Capital Advisors, regarding a possible November bond election for 1, potable water infrastructure, 2, drainage infrastructure, and 3, emergency services and municipal building facilities. And also call up agenda item number 6, discussion with the city's bond counsel, Oric Harrington, and I'm just going to say Oric, regarding a possible November 2022 bond election for potable water infrastructure, drainage infrastructure, and emergency services and municipal building facilities. Again, this council, this is your opportunity to have the dialogue with our advisors and our bond counsel to try to flesh out any remaining questions that you have. And we can, we're not really posted for action this evening, but you'll see this bond discussion continued on the next council agenda later, actually next week. And hopefully we'll get what answers you need tonight to make a final decision on these issues next week. So with that, how do we want to proceed? Do we have?
We do have James Gilley here with U.S. Capital Advisors. He has a short presentation that we're happy to give or just answer questions, whatever the council.
Great. Let's
would
start with the presentation, and then we can kind of go from there. And again, this is a roundtable, kind of work group, work session type of situation. So jump in as you see fit, as you have questions or comments, and we will go from there.
Good evening, everyone. It's a pleasure to be here. I'm James Gilly with U.S. Capital Advisors. So we've been invited here to talk about the potential bond election. There's, just to oversimplify, we're going to talk about two aspects. One is a financial aspect, and the other is the legal aspect, the process of the bond election, which Mr. Kyle here will discuss. But I've prepared just a kind of more of an informational, just a few different scenarios just to kind of get the dialogue going. And I'll give just a brief overview of assuming I can control this and figure it out, I'll give just a little overview on what each page is, and then I suppose you can stop me at any time if you have any questions. So, okay, that's what I was going to go for, the down arrow. So this is just summarizes the city's outstanding debt service, the general obligation bonds series 2012A, the 2014 bonds, the refunding bonds from 2019, and the 2020 tax notes. This just shows you the structure of your debt service.
Can you guys see better?
That's good.
So this is kind of a payment grid that just shows a few different scenarios that I discussed with Ashley. It shows your 2020 tax assumptions at the top, the assessed valuation, your 21 tax rates, and the three boxes show. The first box shows water line, fixing the water lines at approximately $5.3 million at a term of 30 years. The drainage project of, I think half of the drainage project is $8.9 million, also to 30-year term, and the municipal facilities at a 20-year term at $2.5 million. And as you can see, kind of in the middle of those boxes, these are just a rough estimate of what you might expect the annual debt service payment to be, what you might expect the tax rate to be, and the average annual cost to a homeowner with $1 million valuation. I understand that may be a low-end value for a home in Rollingwood, but we just decided that $1 million is easy to multiply. So, so those are just kind of the projects that Ashley had identified. Said these might be some of the projects that at least the parts of it that the council may be looking at. And this is a similar page. This is just showing some of the council members that asked for specific borrowing amounts. So this shows, this is a little different, but it shows the top box a $5 million project cost at 20 and 30 years, $8 million at 20 and 30 years, $10 million at 20 and 30 years, and again, the estimated tax rates and costs to the homeowner. And the following page also shows, went too far, this would be $12 million, $15 million, and $20 million, all at 20 and 30-year terms. And so this is at the risk of yes?
I would say, before you move on, can you explain, there are three columns on here. One says current, and then one says plus 25 BPS, and then plus 50 BPS.
Yes, I'm sorry.
There's no explanation.
Yeah, I apologize. So at the top right, we've just tried to give a rough estimate of what today's interest rates might be, just again, kind of a conservative estimate. We were trying to give you kind of a sensitivity analysis of where rates might go and the effect on obviously on the tax rate, the debt service and the tax rate. Thank you for interrupting me. I apologize. I meant to explain that. But so those three columns. The left column shows about today's interest rate at a 20-year term and a 30-year term. 20-year term we might expect a 44% interest rate, adding 25 basis points or 50 basis points. So as I'm sure y'all are well aware, the market's pretty volatile right now, and so this was just an attempt to give you at least some kind of range of what the impact of rising interest rates might be.
James?
Yes.
If I might ask a question, if you look at the line that says cost to homeowner per $1 million, if you want to get a feel for what the impact to a resident would be, would that be the line you'd look at?
Yes, that's correct.
Okay, and so for just looking at the current interest rate column, that's assuming 4% interest rate on the bonds.
That's right.
When they're sold.
Yes.
And so if you did $12 million on a 20-year bond, the average the cost per $1 million would be $615 a year.
Yes, an additional 615.
Yes.
And again, we selected $1 million because if you
Per
can,
million.
you can multiply that. If you have a $2 million home, that would be $1,230. So.
Right. And under a 30-year bond, it drops a little bit to 501. Okay, all right. And you can do that through each scenario?
Yes, that's correct.
Okay.
So again, there's a lot going on in these pages, but we were really just trying to provide, just for discussion purposes, in case y'all said, well, what about this amount, what about this amount? So hopefully you can kind of piece together and get an idea of what the consensus of the council might be.
Right.
James, I think, oh, I'm sorry, Brooke.
And then those numbers would also be influenced by how you structure the actual debt service payments.
Yes, that's correct.
Okay.
And that's an excellent point. These are rough estimates. This is just assuming, a level annual payment. And not to move forward, but the last two pages, I just thought I'd kind of illustrate the point I think that you were getting at is this is kind of an example of if you issued $20 million at a 20-year term, it's possible that we may be able to structure the principal payments to kind of shape around your existing debt, which drops off in 2027. So an attempt to kind of mitigate the impact on the tax rate. And of course, if you're reducing your principal payments a little bit, that's going to add to the overall interest on the loan, but weigh that with the impact on the tax rate.
Okay.
So.
And one more, on the page we're looking at now, page 6, the impact to a taxpayer in the left-hand column as an increase to the current total tax rate.
Yes, the far right column shows a percentage increase over the 21 tax rate.
Okay.
Of course, we don't know the 22 tax rate yet, but so the column, the second from the right that has a highlighted, that would be the total
Tax rate.
debt service plus M&O tax rate, assuming I believe Abel had said that you're thinking that the M&O might, was it 9 cents? 9 points. Okay, so that, again, these are just estimates, but that assume the INS debt service tax rate under that heading, that shows the calculation of your existing debt plus the proposed general obligation bonds, and then a total INS debt service tax rate.
Thank you.
And there's a following page that shows a similar layout, but over a 30-year payout, just to illustrate this is what the debt service might look like.
And this is with a level debt service.
Yes, ma'am. This is with a level annual payment. So the annual payment should be relatively equal within, say, $5,000.
And so I'm seeing a few eyebrows. With the level debt service, the column total is roughly the same every year.
Yes.
Okay. But the percentage impact to the tax rate is a little higher in the first years, drops off in the later years because you're retiring some of the existing debt over that time period.
Yes.
You're keeping the debt service the same, so you're paying off more principal.
That's
over
correct.
time. Compared to the prior sheet, which is also 20 years instead of 30 years. And your debt service, you've got a different structure for the debt service. I forgot what you call that.
Yes, that would, it's a kind of
Deferred principal.
A deferred principal. We're deferring some principal in this scenario. And you'll notice that your debt tax rate is actually going to drop off by a few pennies, looks like, from what it currently is to next year. And that's not a result of your debt service dropping off, but I believe it's because of the increase in assessed valuation. I've also assumed just a modest 3% annual growth rate, annual increase in an assessed valuation for, I believe, the first 5 years. That's based on Rolling Woods histories. I would think it's pretty modest, so yes, that's correct. The debt tax would drop off over time.
And now, also, one question I had too, the first 2 years, the 2022 and 2023, don't show any debt service for a new bond issue.
This is assuming, I'm showing your current debt service, so this is including your outstanding debt service as of today. We're at the end of the fiscal 22 fiscal year. So we're assuming that with the November bond election this year, the city may, depending on your timing and your needs, we may plan a bond sale sometime depending on your needs again, but sometime perhaps in the spring or summer of next year, with the intent of having sold the bonds, incorporating the debt service into your budget and tax rate, and then having the first payment, if possible, having the first payment in the following year after you've already begun to collect tax levy to pay for that. So the first blank line is the current fiscal year, which is almost over, and the second blank line would be next fiscal year, when presumably you might issue the debt, and so that the first payment wouldn't come due until the following fiscal year, when you've begun to collect a levy to make the debt service payment.
The first payment wouldn't become in January of the bonds would be sold in middle of 2023. The funds would be received after September of 2023.
This is just, again, y'all let me know what you need, but this assumes bond sale sometime in July of next year.
Okay.
This is just for discussion purposes, but assuming you sold the bonds in July, the transaction would close approximately 30 days later. So in August, you'd have funds in hand.
Okay.
Presumably about this time next year, you would finalize your budget, set your tax rate on the debt service that's coming due next year. So this assumes that you wouldn't make a payment until February of 2024.
Okay.
And the reason is that you don't want to have a payment come due before you're able to have revenue come in to pay that, assuming these would be paid with taxes.
All right.
So if your first payment comes due February of 2024, then presumably January, the month prior, you've already collected tax revenue to make that first payment.
And the first time tax would be due on the new debt. The new tax rate would be to the homeowner. The new tax rate would be applied in January and paid in September, or when do we?
No.
Paid in December, I guess.
So the
Is that
first
right?
payment,
Or paid the.
first payment so we would issue the bonds in fiscal 2023, and I expect that the first payment wouldn't come due until the beginning of fiscal 2024. Well, February of 2024.
February, okay.
Yeah.
So it would be assessed.
They would pay it December or January,
Right, I'm
What
sorry.
year? Okay, so that's when it would hit the homeowner, okay.
Yeah, clarification on that. So we're in 2022, right? And we're working on setting like tax rates and things like that for our next fiscal year. But the payments that are due on property taxes in January are for the current year, like the 2022s, correct?
So the Today,
It's-
this year's valuation, calendar 22 assessed valuation, the tax year 22, you'll levy taxes on that to fund fiscal 23.
Okay.
So, I said that right. And that's shown on the left side, the fiscal year 9/30.
I'm just trying to
and
figure
then the
out,
tax
sorry,
year.
I'm just trying to figure out, like, if you sell them in July,
Yeah.
and then there's, we set it, we're gonna set our, next time this year, we're gonna be setting our rate, but we're gonna set a rate to cover these bonds, assuming that if it all goes through, assuming that happens. We set a new rate to pay that, but the taxes that are gonna be paid in January 2023, or 2024, like, don't have that rate.
Oh, they will.
No, they will.
They will.
They will.
Okay.
They have
That's
the
how
new
it
rate
work-
with
okay.
the old value.
Okay,
So-
okay. Okay.
Jared can correct me, but I think that you're not able to levy a tax to pay debt that you haven't issued yet.
Yeah.
So,
Right, okay.
again, depending on your needs, it may be optimal to time the bond sale before, shortly before you set your tax rate for the following year. So you know what your next year's payment's gonna be, you know what your values are gonna be, you set a tax, an INS tax, so that you can collect funds in January to make the payments that are coming due in that year.
It's similar to our
So-
fiscal year. Our fiscal year starts October 1, so you're October, November, December, and then they pay in typically January. You could pay in December if you wanted to, if you're not on escrow. So you're a quarter into the fiscal year when that tax is finally levied.
Okay. So, yeah, sorry.
No, no, that's
One
what
more
it,
thing.
no, this is great. Keep going.
So all the assessed values that came in this spring, right? That is for this year, right? And so the rate that we're setting in September, that applies to whatever that value is.
What we're doing, and when we talk about revenues next week,
Mhm.
you will see we've already been notified by the tax appraisal district how many properties are currently in protest.
I guess what's kind of confusing to me is like also like we're setting a budget for the next year, and yet that's the thing that it seems to me that I don't know. I had to just think about it offline, I guess, but it just seems like there's just a weird overlap here. And I'm sure that you can't sell a bond without or like tax before you have the bond. That makes sense to me. So I'm sure it all like works itself out. I'm just trying to figure it out in my head.
Yeah, and actually, the overall system is really designed to sort of. That's why if you think through the requirements for when the bond election, if it's going to occur, it has to be called next month. So it's all of these things align with our budgeting cycle and season, and so if you'll notice that these decisions that you're making on this bond issue are also coinciding with the same types of decisions that you're making related to. I mean, we just posted for what we post publicly for the tax rate, and then we have to have the hearing on the budget, and then you're having to adopt that final tax rate. So all of those things are aligning.
Mhm.
Even though the bond piece is sort of a separate discussion, it's still the timelines are all aligned.
So, imagine y'all had a successful bond election last November, and at this council meeting, perhaps we were presenting to, the bonds were just sold, and you hear the final debt service numbers, and you know what you're gonna pay next February. So then you would take that debt service, and you'd be able to calculate it into your final tax rate that's going to fund next year's budget, so.
And I would actually argue that it's better aligned today than it has been in sometimes past, because historically cities, prior to 2019, it was an 8%. Cities would just come in and adopt an 8% increase every 2 years, and that was the way it went.
Mhm.
But if you think through this, what we're doing here, and we just had a discussion about the no new revenue rate and the voter approval rate and those things, it's set up so that you have the opportunity to, as you are potentially adopting a no new revenue rate, you could say, I'm not going to do the 3.5. I'm going to do a no new revenue rate, which means it's totally flat for the resident. But I have a good story to tell you, citizens, about some things we need in drainage, some things we need in water, some things we need with emergency services. And so I'm going to adopt a no new revenue rate over here. But I'm going to make my best case to you over here on why we need to pass a bond. You decide if I've told you, if you agree with me that it's a good story or not. So you're at a no new revenue rate over here, but then the voters have an opportunity to decide whether they agree with you or not, that there are some needs that need to be met with a higher rate. And then all of those come together in a final M&O and INS rate for your combined rate going forward. So as opposed to the way cities did it a lot previously, it was like, oh, just 8%, 8%, 8%. So.
Yeah, it makes sense to me. And then like next year in the budgeting process, if these funds were available, then I guess you would plan, I don't know, like when you would like plan which projects or like how all that would flow later on. But I assume that you have some of the funds that next year you don't just hold it. I mean, maybe you do, but you probably have a project or two that you want to apply it to, right?
It would be, I mean, we would work, our staff and myself would work with you all in trying to prioritize those. There's been a lot of work already done with the IIP and the CIP and some of that. And we have priority levels. I think on the CIP, we talked about where it's sort of these broad kind of, well, these are more important and these are less important. And then over on the IIP, we really have it kind of boom, 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 boom. This is where we see the flooding. This is, I mean, they're prioritized. So, and then we would look at both of those and see where there's alignment, where there's stuff in similar areas, so we don't have to tear the streets up at different times. So it would be a more robust process to figure out what we fund and on what timeline. But
I guess you would know by the end of November, and then you have the time for the next budgeting cycle.
And you're sort of hinting or dancing around a question, honestly, that I have, and I don't know how to quite ask it, but I'll ask it sort of in the terms that I'm familiar with, which would be like a construction loan. So if we have if we have an approval for an overall bonded amount, what is if, for instance, we take $1 million, let's say it's a $10 million approval, but we take a draw on $1 million. We're just paying, what's the schedule? Are we paying the debt on the entire 10 or just on that one? What is the deployment schedule?
If the bond election is successful, for example, if the $10 million bond election, this is kind of Jerry's realm, but you want to explain?
How long do I have to deploy the capital? And anyway, go ahead. I think you see where I'm going.
Yes,
Yeah.
Mayor Jerry Kyle with Laura Carrington and Sutcliffe. Good evening. You can issue the bonds all at once as one single installment, or you can issue in installments over time. Typically, there's questions about economies of scale and things like that.
Get to the mic. Go to the mic, just so we can pick you up in case there are inquiring minds at home.
Sorry. So in response to your question about how you can access the funds, assuming the bonds are approved, you can issue all of the bonds in one series of bonds at one time. You start, accruing interest, paying interest on the bonds as soon as you issue them, but you have access to all the funds right away. If it makes more sense economically because of for economies of scales, timing, when you're expecting to need the money, that kind of thing. If it makes more sense to access the money in increments, you can certainly issue, in 3 installments, 4 installments, whatever. Then it's just kind of weighing your economies of scale against other considerations. As a smaller city, a larger city, you'll see commercial paper programs and other types of interim funding programs where the city can access the funds kind of when and as needed. But for a smaller size transaction and for a smaller city, there's issues of having the legal authority to set up that kind of structure. So typically for a transaction of this size, it would be a bond issue.
And what's the timeline? Is there a timeline or deadline for deployment of all the capital?
There's kind of a presumption of staleness if you don't issue your bonds within 10 years.
Okay.
But it's.
So it's not a 2-3 year.
Oh, no,
it
no,
could-
no.
Okay.
At least 10 years, and it's really not that hard to overcome the presumption if you have a good reason for going
Gotcha.
longer.
Okay, so then back to you, Alec. So I would envision if we did something like this, that we would, speaking personally, as someone who would be overseeing this, I would not want to issue all of that debt at once. And so my thought would be we would probably spend 5 or 6 months thinking about the right buckets, the right time frame for some groupings of projects. And then look at sort of a long-term deployment. That would also help us so that we're not paying that bonded indebtedness too much before we can actually put the money to use. So that would be my thought, but I didn't know that until I knew that answer, so.
But then, like, the point with that is that you still have to know before the next budget cycle, right? Because any, I guess, project that you would do like this would have to be budgeted during the.
It goes
budget
directly
or-
into your INS rate, and so
Okay.
there's no, I mean, yes, you do budget for it, but it's baked in automatically.
But even if, like, let's say, so what you're saying is that it could be approved, the voters could approve this, but then we don't have to really issue it until we need it.
Yes, sir,
that
that's right.
correct?
This is just authorization to issue bonds.
Okay.
You may never issue the bonds.
Mhm.
Hopefully you will,
Yeah, okay, got it.
but you're not required.
Spoken like bond counsel.
And then, okay, back on your comment about, well, you could break it into small, maybe you could do, and you talked about the economies. By that, do you just mean like just the overhead of going through the process of like issuing the bond each time?
Yes, sir, yeah, because
Okay.
there is a process, depending on whether it's a private placement, competitive sale, negotiated sale. There'll be an offering document, there'll be, the documentation that we prepare. So there's definitely a process and cost associated with that, so.
So would any sort of ordinance that was adopted to do this, to get it on the ballot, would it have to be language in there about whether or not you were gonna do this in chunks or one, or?
No, that's really the authorization, again, it's just authority to issue the bonds for the purposes authorized under the propositions. Otherwise, decisions about when to issue, how much to issue, those are all determined after the authorization is obtained.
Okay.
Can you speak a bit to the kind of general language for authorization that's in a bond resolution or a bond ordinance as compared to the specificity you might want to be able to describe what will be done with this money if it's approved? How do cities handle that?
So the bond proposition, which is the kind of the legalese that's in the election ordinance, will basically cover things like authority to issue the bonds, principal amount, purpose, and some of the kind of general terms. But you're right, it's very it's specific to purpose, but it's general otherwise. So the cities typically prepare voter information materials. So assuming y'all call the election, then working with city staff, y'all would prepare voter information materials that do a little bit deeper of a dive in terms of kind of more plain English, kind of describing, what the intended uses of the proceeds are. And there's just some legal issues around that too. It has to be factual information. It can't advocate for or
Helpful.
can't advocate for or against the measure. And so typically, James and I will work with city staff to make sure that the information is indeed, factual. So.
And is that the more specific information, would a council adopt that by resolution? Or is there any formal process for that?
There's typically not really a formal process. There's no reason that council can't, weigh in. But typically that's kind of city staff just kind of, working around the plans that have been kind of formulated.
Yeah, maybe this is related, like, let's say 10 million or whatever, let's just use as a number, and then we decide to only do half of it, at some point in the future. Like, who makes that decision on well, we're gonna do just 5 million? I mean, does this come back to like the city council then to actually
Oh, yes, sir.
issue
Yeah.
the bond? Okay.
Yeah, absolutely. Yeah, the issuance of the bonds comes back to council. There's a bond ordinance
Okay.
that authorizes issuance of the bonds, assuming, for instance, that, all three propositions pass. The bond ordinance, and assuming you're issuing, say, just half the authorization, the bond ordinance would stipulate which propositions you're drawing from and how much, and then those proceeds and those amounts would be restricted to uses for those purposes. Back to the discussion about the tax levy, the bond ordinance will levy the tax, and so it'll levy a tax for as long as those bonds are outstanding on the INS side. So, short answer is yes. We would definitely be back to you for that authorization.
Okay.
Quick question too. Do you know offhand, can bond proceeds be used as matching funds?
They
Federal
can,
or state?
I mean, for like a federal or state
Federal or
program
state,
something?
yeah.
Yeah, I mean, we'd want to talk about the program.
Sure.
But yeah, there are situations. where-
Generally speaking, they could.
Yes, sir. Yeah.
Okay. I don't have anything in my mind,
Do you have
but
a matching in your pocket?
might at some point.
Okay. That'd be great. So, couple of things just to kind of bring it into a little bit more layman's terms. So, I hope I'm not insulting anybody out there, but basis points, so when we're talking on the page with the current, say it was 4%, and then 25% basis points be 4.25%, 50 basis point be 4.5%, that type of thing. So I just wanted to clarify that for anyone listening. And then my understanding of this is the voters will give us basically permission. They're granting us, if they vote for these things, they're granting us permission to issue bonds up to a certain amount, and we don't have to spend everything, and we will probably, with the mayor, work on structuring and laddering some of these, and the taxation of those won't be due until the bonds are issued. So it's not immediately going to be a hit to people's pocketbooks that they're not seeing benefit for it. It will be, the bonds will be sold, and then the following year you will get taxed based on what debt has been incurred.
Yes, sir, that's correct. It's
Right.
kind of a gating issue almost.
Right. So,
And you have 10 years to use the bond funds.
Right.
There's kind of a presumption of staleness, so you have at least 10 years. And for instance, if y'all are actively working the program and you issue, say, 2/3 in the first 10 years, but for some reason, planning or otherwise, you haven't issued within 10 years, that's a pretty easy explanation. And the person that enforces the presumption is the Attorney General's office.
Okay.
Your bonds have to go to the AG's office for review and approval. And so they're the ones who enforce that, and if you have a reasonable explanation for why you haven't issued within 10 years, I've never had an issue with that. So.
Great. Yep. I don't have a big plan on what the next talking point is, so feel free to continue on. Did we make it through the presentation in its entirety? I mean, I know we sort of went down a rabbit trail there.
Yes, that was, again, it was just for reference, just as kind of an at a glance, just for talking purposes. So that was the entirety of you glorified by calling it a presentation, but it was just kind of for reference. That was
Okay. Yes, ma'am.
I have one more question. If we can go to the next page. it's 2 pages prior, sorry, the one that has the current debt service. That's it. Can these tax notes, which is a $2 million issuance payable over 8 years, can those be refunded with the way that this current bond ordinance is written? Do you have to have any special language? Or is that just something you can negotiate at the time you sell the bonds?
The tax notes are callable at any time. They are able to be paid off or early or refunded, and that was something that an option that we requested from the purchaser. So yes, they're able to be paid off or refunded, but in terms of whether or not that can be incorporated in a bond election, I'll have to turn it over to.
Does it require a vote in?
No, no.
Okay.
And so the new money bonds would be under the authority conferred by voters on the bond election, but you could aggregate refunding bonds and issue combination new money and refunding bonds as a single series, and it does not require an election to add the refunding component.
Okay, and so the current drafted ordinance would authorize that?
Well, it wouldn't speak to it because
It's not necessary.
It's not necessary, yeah.
Okay.
Y'all can issue refunding bonds without approval of voters, basically.
Okay. And so if the actual principal from those tax notes, the $2 million, is spent on structures, capital improvements that are gonna last 20 or 30 years, there wouldn't be a problem with refunding them to a longer debt service schedule?
That's a great question. Yeah, so there shouldn't be, because
Okay.
the useful life should be long enough for that, if it's a 20-year useful life. But there are federal tax and some limited state law requirements you have to look at to make sure that your amortization isn't too long relative to the useful life of your property.
Okay, all right. The interest rate on those is like 1.5% to 2%, I think. It's well, I'll show you. And this is just impact. But if you look at the total debt service for that $2 million, we are paying $350,000 a year, $315,000 a year. If you look, for example, your principal payment is about the same as the principal payment for the Series 2019 with an outstanding principal of $9 million. So if you want to lessen the impact to current property owners and the asset's gonna last 20 years, then you're asking current residents for the next 8 years to pay for something that'll be useful for another 12 beyond when they're here. So, from a equity standpoint, or from there are reasons to have that, that kind of financial instrument, but if you're gonna use it to pay for a 20 or 30 year asset, you might stretch it out.
Also look at the interest rate. to see
Right.
What effect that's gonna have
Right.
on the whole picture.
You could do the same thing, couldn't you, if you deferred some of the principal on the new bonds?
That's the difference between the structures in the 20 and 30 year, you can, yes, you can.
But like, instead of refinancing something that you're paying 1.5% on, you could defer some
You
of the
can
principal,
structure
and that way
there's
you would
yeah.
still be paying the same amount, but you would have the benefit of the lower interest rate.
Right. Yeah, smooth the payment.
Although.
Yeah.
Yeah, that makes a lot more sense. You don't wanna retire at 1.5%.
Mr. Mayor? Oh,
Sure. Ask it here, and then I'll ask it for you. I'll repeat it.
My question is, I'd like to hear the pros and cons since they presented this, of 20-year amortization versus 30 years.
Okay.
So,
20-year amortization versus 30-year. Will you talk to us about that?
Certainly, it's an excellent question. Obviously the 20-year amortization versus a 30-year amortization, 30-year, you're paying more interest over time, but as was pointed out, it's important to match up the financing term with the useful life of the improvements. So you wouldn't want to buy new computers for City Hall and finance it for 10 years. But if you're funding a City Hall, which might reasonably expect it to serve for 20, 30 years or even longer, that may be a reasonable decision to select a 20-year versus a 30-year. As I understand, the engineers have said that the utility line improvements are expected to last 30 years easily. So the idea would be that, as was mentioned, you'd want to spread out the cost of those improvements to future residents, to current and future residents of Rollingwood. That's one justification, but I certainly would encourage you to select a term that is matching up to how long you expect those assets to last. And I don't, real quickly, I don't think that, it's not necessary for you to issue all of the bonds at say a 30-year or 20-year or 25. I don't believe that it's necessary to say, this is how long we're going to issue the bonds at this time, and you have to stick to that. So you could potentially issue the water lines at the 30-year term and a separate issue, the City Hall or any other improvements at a shorter term. So that's it's a decision for the council and with input from the engineers.
And my question to you would be twofold. One, if you did the issuance of the bonds in increments as a construction loan, as you suggested, is there a risk then of interest rates going up or down as you issue each one of those increments? So you're taking a chance instead of fixing it at one point in time. And I don't know that that's good or bad, but it's a decision that has to be made, and it ought to be made knowingly instead of just assumed. Number one. Number two, if you issued in increments, roughly what would be the differential in cost? Because I'm sure we have more legal fees, we might have a different discount rates, we might have a different real impact to the issuance cost if we went out in increments versus, again, the known versus the unknown.
Okay, repeat that for the record. So if we look at incrementally for issuance of these bonds, what risk do we run in rates over time, and what risk do we run with closing costs?
Sure. Again, excellent question. Jerry kind of touched on this earlier, but so there's, let's say you had a successful bond election for $10 million and you decided we're going to issue all $10 million all at once. Well, what happens if next month interest rates go down and you're smacking your head? Or if you issue, say, $5 million today and then you wait and 3 or 4 months later interest rates go way up, obviously that is an interest rate risk, and that's an excellent question. So the flip side of that is, well, do you want to issue, even if you knew that rates were going to go up, would you issue all of the bonds right now and not know how long it would take you to spend those? So once you issue those bonds, even if you had a relatively low interest rate, you're incurring interest, you're accruing interest, and you're going to have to start paying interest on that. So, there's no crystal ball. I think we just recommend that issue the bonds when you need the money, and there's just, there is some indication that rates will go up, or there is some I guess indication where the market might go, but it's just, again, there's no crystal ball. So and again, there are questions about how long can you hold, if you issued the bonds, how long can you hold on to the money before you have to spend it?
Great point. Reasonable expectations. You do have to have a reasonable expectation to spend the proceeds within 3 years. So, and there's some little exceptions to that, but just there's one legal rule around.
Reasonable expectation to spend it once it's issued?
Yes, sir.
Okay.
And
Deeds.
I'm sorry, Mary, if you don't
Finish.
mind. You asked another question about
Kind of a closing cost
issuance,
question.
Issuance
Yeah.
costs.
Yeah, issuance
There
costs,
are
yeah.
redundant, there are some redundant costs. There are, likely we would request, depending on the term, the details, we would request a bond rating from a rating agency. At each time the city issues debt, the bond rating agency would charge a fee. So there are some redundant fees. I'd say that they're not negligible, but they aren't necessarily a deal breaker if you're issuing, I guess, larger chunks of money. If you're issuing, for example, $1 million at a 20-year term or a 30-year term, it starts to get a little inefficient. If we were to sell these in the public market, which the city has a track record of doing, has performed very well in the public market, there's these large institutional investors are paying attention to this, and they're going to be bidding. They're going to be bidding on the city's debt, and if it's a smaller issuance, they as was said before, there's an economy of scale, so they like to see larger issuance, and you may get less interest in the issuance and the sale, less participation, or you may suffer from odd lots, having say 100 round numbers, 100,000, at least $100,000 in a specific year, a specific maturity. So there are certain considerations, and that's something that we'll work with city staff to look at the pros and cons of the economic impact of the size of the issuance.
This is kind of a takeoff on Brian's question. What if you're selling 4.5% bonds and 7% environment? You have to issue them at a discount.
If you're issuing lower interest in a higher interest environment, do you have to?
Yeah, so again, if the city were to issue in the public market, we would be offering, essentially, we would be inviting investors to submit their own pricing. So you would be essentially a primary offering. You'd be selling these to a large institutional investor who would likely mark those up for resale into smaller retail customers. So that's a long way of saying the investor will determine the pricing, will determine discount bonds versus premium bonds. In the current market, it's common we expect that these might be sold at a net premium to the city. So depending on the circumstances, we would likely offer these for sale in a competitive kind of auction type bid, where we would solicit bids from investors across the country, and so they would be competing against themselves to offer you the best price on the bonds. So they'll do their own pricing, and so the lowest interest cost to the city will win, essentially. So.
Mhm.
Basically, they're bidding on what interest rate they're willing to accept. And
So when we authorize these bonds, we're not authorizing a specific interest rate that we're going to pay.
Correct.
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 Well, can't you, sometimes the city might put a not to exceed interest rate in the bid package, their bid package?
When you go to bid, yes, you might do that, yeah.
Yeah.
In terms of again, this is kind of a gating issue. When you're going to the voters, those types of specifics typically aren't.
Right.
And as I recall, council would actually have final approval on where they go to, don't they? Or once you go to market with the bonds, do we have some input at that point?
Yes,
I thought I remembered that from a
we
previous.
would, again, depending on the specifics, but most likely we would offer them for sale. We would, once the pricing was finalized and the winning bidder was determined, we would present the results to council, let you know that the true interest cost, the interest rate that the winning bidder offered.
That's what I was
And
remembering.
you would have the opportunity to say, yes, we approve the bond ordinance, or no, we're not going to go through with the sale.
Okay, that's what I recall. Yeah, that is, there's sort of a last bite at the apple kind of thing. Quick question too, and then I saw one that just came to mind. Would it be acceptable within the bond proceeds to use the bond proceeds to say, hire a project manager for oversight of, say, a grouping of projects?
I mean, if that's for the projects.
Specifically for the project?
Yeah, if the project manager's engagement is to facilitate completion of the projects, yeah. It should be a capital, y'all should book it as a capital expenditure. That's kind of a accounting question, and that's usually what we're looking for, is we want to know that it's a capital expenditure.
Okay, but there would be a way to structure it.
Yeah.
Okay.
I had
Bill?
a quick note. So my understanding is that historically the interest rates on these kind of bonds are less volatile than, say, they are for your mortgage or something else. Is that true or false? Or is that correct, that they don't tend to bounce quite as quickly?
Well, it's based, it's just what the
It's
market.
open market.
It depends
Okay.
on the market. I would say that Rollingwood certainly is an excellent credit. I would say that, in terms of interest rates going up, it's largely, a lot of it is driven by, obviously the economy, but what the Fed is talking about. So if the Fed is announcing, well, we likely will raise interest rates another 0.75% in the next, next meeting, the market tends to price that in ahead of time. So it's not like it's not common that the Fed would make an announcement, that at the meeting that morning, then it was a huge shock. But it tends to price in the movement, anticipated interest rate movement. So I'm not sure that. Yes, I'm sorry. If that's what you're asking, once pricing was finalized and the ordinance was approved, the interest rates would be final. The payments would be fixed.
Right. Well, once the bonds are sold,
Once
then
yes,
they're sold at a fixed rate. Right. Yeah. No, I'm clear on that. Yeah. I was just thinking that when we're concerned about perhaps laddering some of these sales, that might not be quite as much of a concern as it might be with some other things. But what I'm hearing is, yeah, it's the same. It would. That's right. Be just as much. Okay.
Would you anticipate that these will be tax-free bonds?
Tax exempt.
I'm sorry?
Tax exempt.
Tax exempt, yes.
ma'am.
I was trying to find
Federally
that word.
Tax exempt. Yeah, there's nothing about any of the projects that would lead me to believe that there'd be anything other than tax exempt.
Tax
bonds.
exempt.
Yes.
And then also, my understanding is that, let's say we hit the market next year and the interest rate's 4.5%, and 2 years down the road, the Ukraine war is over and interest rates come back down some, or whatever's impacting the market, interest rates come back down. Is it possible to have a refunding where you can take advantage, the city can take advantage, in essence, a refinance of those bonds to get the lower interest rate?
So legally, the answer is yes, but as James pointed out earlier, there can be a redemption issue. So depending on where your redemption dates fall, and typically there's a redemption feature in these bonds. It's usually a 10-year redemption at the option of the issuer. But yeah, legally you can issue refunding bonds at any time as long as there's a public purpose. Usually it's savings. So.
And on those refunding bonds, you don't have to have the same term. You can change the term around, or
Yep. The refunding bonds, the proceeds from the refunding bonds are used to redeem, or if it's an advance refunding, they're used to fund an escrow. And the escrow basically provides the new sources of security for the old bonds. So the old bonds are no longer really an obligation of the city at that point. It's the new bonds, and yeah, you can set the terms however you want.
I have a question for James. A couple questions. Can you talk a little bit more about the public market and how they're sold again? And is it the initial investors you go to, they buy them and they typically hold them, or do these things like trade eventually? Not that it necessarily affects us, but I'm just kind of curious.
No,
What
they
happens?
we these, as I said, these are large institutional banks that I'm likely have heard of. You know, banks like Chase. You know, I'm sorry, I'm drawing a blank, but yes, they are buying them in wholesale, and their intent is to mark them up and sell them in smaller chunks to some of their smaller retail customers. So that so they will be trading, you know, in the secondary market. The city's outstanding bonds are currently, they're still on the market. Their smaller customers may be buying and holding either for, you know, investment accounts. Maybe, you know, Edward Jones may buy a chunk, and for some of their customers. So there's people across the country may be holding Rolling Woods bonds. So
Okay. Then the next question I had is, can you speak to like the debt profile? I know you gave a nice like chart, or someone put a nice chart in the table in there showing S&P AA cities with the basically the outstanding debt of some of these cities and some of the ratios. I guess what I'm really trying to understand is like, is there like some rules of thumb, like if all this got approved and like say it was, I don't know what it's 17, 20 million, something in there, I mean we've like tripled or doubled our debt. I mean we're like kind of, I mean I'm just trying to figure out are there some like ways to like measure like whether or not that's like a good financial thing to do.
well, you know, I'm not sitting on that side of the desk, but the answer is, if you need the improvements, the answer is yes. If your water lines are breaking up, you need to fix them. Yes. From a rating perspective, I think I kind of touched on this in some of the questions that were sent out, but you know, that is an aspect that rating agencies are going to look at your debt burden, and I think in Rolling Woods' case it is slightly high, but you know, that's weighed against the fact that, you know, rating agencies will look at a governing body and say, okay, they're being proactive. They're looking forward, you know, 2 years, 3 years, 5 years ahead of time, and taking steps to maintain their infrastructure, as opposed to not doing anything for, you know, 30 years and then all of a sudden they have, you know, they got to break the bank. But I did send I think you're referring to the list of cities in Texas. You know, yes, Rolling Wood does have a high debt per capita, I would say, relatively speaking, in terms of AA cities. But you know, there's a few caveats there. You know, y'all are landlocked. You don't have a lot of room for. You know, you're obviously not going to expand your territorial boundaries and incorporate new citizens. But I wish I'd sent this, but I just printed this out before I came. I looked at all the cities in Travis County, all the taxing entities in Travis County, and Rolling Wood is down at the bottom in terms of its total tax rate. So y'all are 21 cents. You know, Manor is, this could be wrong, but just at a glance, Manor's 78 cents. That may or not be right, but Laga Vista, Elgin, Austin, Jonestown, Cedar Park, Round Rock, they're all higher than y'all. So kind of put that into perspective. Y'all have a pretty low tax rate, and you know, based on the projections, it's not going to knock y'all up at the top of the list. So
I found that same report, I think on the state website, showing the different counties and the taxable entities, and kind of filtered it out. It's about the total tax rate. We are like a little below the average for sure. There was one other thing I was going to mention as you were talking about that, but it just slipped my mind. Oh, I know what it was. That's what I wanted to see. Do you have the data? Can we get that maybe in the packet or something added, or on the S&P in Travis County? Like, because you showed like the AA cities. I'd love to see just the comparison, the same thing.
that really long list of AA cities with.
He's talking about
Yeah,
Travis
I'm just
County.
talking about Travis County. Like, instead of comparing this, I just was curious to see how we match up with the cities right around
Sure.
us.
That longer list I pulled from the Municipal Advisory Council of Texas, and in terms of the tax rate, I think it was the Texas Comptroller, I believe. Again, I wish I'd thought about this earlier, but I could do that. I could provide you with a list of all the tax rates city.
Well, I have the tax rates in the city, but what I don't have is like that nice chart that showed how much outstanding debt is in each one of those cities, and then what the population is, and what the market value and the assessed value is in all those cities. I was just trying to like look at our numbers compared to the surrounding
Just
cities.
cities?
Yeah, that's,
Yeah,
that's
I can do that. It'd take a little bit of, spreadsheeting, but
well,
that's
yeah.
what I love. So.
I mean, if you, I mean, that'd be great. Thank you.
Yeah, absolutely.
Tom, did you have a question?
Well, two actually, James. One, we may have a high per capita debt service, but from an assessed valuation, I'm guessing that we're on the lower end of that scale that you're looking at.
Yeah, so the question is, where are we on the scale for rate versus assessed value?
That's yes, you're correct. It is a very low. Have about 1% debt per assessed valuation. It's quite low, and I think that is a credit positive in terms of a rating factor.
The second question doesn't pertain to the financial part of this, but just how we would put that on the ballot, whether this would be one bond or whether it would be three different propositions on there that each person could vote.
And so for that, so the question is, how would these be placed on the ballot? And I know this is a log rolling question. Is that correct?
Yes,
The terminology?
that's exactly it. Yeah.
All right. So if you'll talk to about that.
So, yes, thank you. For state law purposes, each purpose has to be a separate measure.
I originally wanted to combine them all, but they told me I couldn't. So
Make it a little
transparent. Alec,
A question, a legal question, and maybe that's what when we go through this ordinance and discussion is the ballot language. Is that what is the ordinance, or when is the ballot language written? Like what it says.
Yes, sir. So the ordinance contains both a proposition,
Mhm.
which is the long form, kind of the contract with the voters, that spells out the purpose for which the bonds are authorized to be issued, and the other general terms we talked about before: general authorization, authorization to levy the tax, to pay the bonds, those kinds of things.
Mhm.
And then the ballot is also in the ordinance, and all the ballot is the instrument that voters see when they go in the voting booth. It's supposed to be kind of a cue. So all it's supposed to do is when somebody votes yes or no, they know that relates to the long form proposition.
Mhm. Okay.
and I would just make a point to all of council, and anyone listening at home, so that bond ordinance is obviously listed in the packet. Again, not asking you to make any decisions tonight, but if you have deep thoughts about the specific language, it would save us time when we bring these back to you on the next agenda. If you could give us a heads up if there's specific language changes, either in the ballot language or anything that we need to run by these guys before next week's meeting. So just keep that in the back of your mind. If there's something specific related to language changes in that ordinance that would, again, if you adopt something, it has to be this next week. And so if we need to change something or you have issues with the actual language, let us know before we get into that meeting next week. Yes, ma'am.
I have one question along that line. I've had questions about whether the water bonds, if we issue water bonds, can we be sure to include paving costs in the water bond issue? And I know as a council we've talked about, we've got this separate sales tax for road maintenance, and we can use that for repaving. But if there were a need to use water bond money for repaving, let's say Rollingwood Drive, a major long thoroughfare through the city, would that be a separate purpose, or can that be included in the water bond funding?
Yeah, unless there's some kind of integral relationship of the road improvements, and really typically it wouldn't be a road improvement. It would be, if you're using proceeds of a water bond, waterworks system bond, you really can't use that to improve a road.
Where the new lines are placed in the road,
repair.
So, yeah, if it's incidental to the water project.
Yes.
Then, yeah, so if you're, basically, if you're digging up kind of a perfectly good road because you need to access your water line,
Right.
and, you know, any reasonable person will look at that and say, well, you're not doing this because of the road improvement, you're doing it because of your water line, then that should be okay, yeah.
Okay.
But
Good
it just needs to be
And you
incidental
don't
to.
have to separately state that. in the
No,
purpose.
it has, to just as long as it's kind of, the reason you're doing it is for the water project.
Okay.
Yeah.
Good question. Other questions? Other comments? Other thoughts? Other thoughts from the audience? You guys?
What about online? We know.
Or online? Oh, yeah, can we? Nothing?
Nobody.
All right, well, I don't know what to do, even thinking about getting out of here in an 8 o'clock hour, so.
Well, and
We have to make up 4 more hours of stuff to do. Brooke's contemplating it over there.
I've got one more question. One more question. And this has to do with the drainage. There may or may not be opportunity for some third-party funding, state or federal third-party funding. Let's say we issue bonds for $4 million of drainage improvements. It works out that we can get half of that funded through another source. What do we do? I mean, we don't know that. We've already issued the $4 million. We get $2 million.
And that was kind of where I was going.
How do we accommodate
Yeah,
that?
and that's where I was going also with that matching question, but I assume the answer is the same.
Yeah, I mean, you could use your portion, your bond proceeds as a matching portion for a match program or something. If you'd already issued the bonds, so you had the proceeds on hand, really there's only 2 things you could do. If you had other drainage projects, you could use the proceeds on that, or you could use the proceeds to pay back the bonds.
Okay. If that's allowed in the.
Oh, you could
fund-
use,
yeah.
I see, yeah, so full
Retire
circle.
it back.
Okay. Let me see.
Drop the rate.
Good question.
You can't redeem the bonds until the redemption period.
Yeah, that's a good question. Yeah, the bonds would have to be redeemable to pay them off, but you could still do a defeasance escrow, where you put them into a special fund that's,
Okay.
basically, it's like the refunding concept we talked about before.
One more question. Sorry, I don't know if you'll know this or whether this is a question for Abel or not. But when you set the rate, the INS rate, is it every year you do it to meet exactly the amount you need to pay back the principal and interest that's owed, the debt service of that year, and you don't set it higher? I mean, obviously you need to cover whatever you need, but do you set it higher sometimes and have extra money to pay down things faster, or is that not?
I mean, you need to account for, delinquencies and other types of, you want to make sure you have enough money in your debt service fund to pay your debt.
Okay.
And in terms of kind of, how you set that, what kind of cushion, that's usually, city staff,
Okay.
within reason.
All right, anything else? Going once? Going twice?
Move to
Again, thank you
adjourn.
guys. We will continue this dialogue, council, at the at next week's city council meeting. Encourage everyone at home to take a look at tonight's posting. We do have the water infrastructure improvement plan.
Mr. Mayor?
Yes, ma'am.
Did you ask for if there was any public comment or question?
We did.
Okay,
And there
all
was
right.
not. But for anyone watching or listening, the water capital improvement plan is posted online. The spatial needs assessment is online. The IIP is online. So feel free to take a look at those. Visit with your council member. We're not adjourned yet, guys. Hey, fellas. Hey, guys. Not adjourned yet. Hey, fellas. Not adjourned yet. Okay. So hopefully those at home will take a look at those items. Visit with your council members. Council, please come ready to have a robust discussion next week and make some final decisions, one way or the other. So with that, I'll entertain a motion to adjourn.
Move to adjourn.
We have a motion to adjourn and a second. All in favor say aye.
Aye.